Hi, good day. This video is for school purposes only, and it would be a presentation of the performance task that I made for our subject course. Subject course entitled Mutual Fund, from Performance Task 1 to Performance Task 3. So let's start. First, I'm going to open the first performance task that I made, which is the portfolio investment. So it's open. So I'm going to flash it here. This is what I made. For the equity investment, I chose company Banco de Oro, Bank of the Philippine Islands, Shelby Food Corp, Ayala Incorporated, and Tel Pelditi. So I invest in their stocks, which is 20 shares of stocks in Banco de Oro, 20 shares of stocks in Bank of the Philippine Islands, 10 shares of stocks in Jollibee Food Corp, and 20 shares of stocks in Ayala Land, and last is 5 shares of stocks in Tel Pelditi. So this I'm going to flash it here. So what I did is I get the current price in the stock market, which can be found in the internet, and its target price, I put it here. The market value. So to get the market value, I multiply the shares of stocks and then the current price. So the annual dividend is here. This is the result, the dividend yield, and then the total yearly dividend. So let's go to the debt investment. So I chose the bond fund of Sun Life Prosperity GS Fund, Soldivo Bond Fund, Philiquity Peso Bond Fund, Sun Life of Canada Prosperity Bond Fund, and Acham Corporate Bond Fund. All of them has face value of 1,000, 1 year maturity date. So each NAV is written here. Their management fee, entry fee range, interest payments is quarterly, and the year to date return, and then the yield to maturity. So here I put the explanation here why I chose those investments. Yes, so that's it for the performance task 1. Next is the performance task 2, which I made in the Google Classroom. Performance task 2 is the associated risks of the investment that I chose. So these are the risks of the investment that I chose for the stocks portfolio: the volatility or market risk, liquidity risk, concentration risk, company risk, and for bond portfolio, inflation risk, credit risk, market risk or the interest rate risk, and the reinvestment risk. So I'm going to read the volatility risk, which is a company's stock is exposed to market risk and volatility regardless of how well it performs. Supply and demand influence stock prices. The price of the stock will decline if consumers withdraw their money from the stock market. This is the risk to me that I will lose money as a result of market fluctuation. It's true that the risk of a portfolio's market value fluctuates as a result of price changes. So for the liquidity risk, this is the risk which results in losses for investors when they cannot sell their assets or convert them into cash immediately, or if they can be converted, still there will be a loss. For instance, I will be forced to sell my shares of stocks for emergency matters and someone will buy my stocks for a lower price and I have to accept the demand because I need the money right away, so the loss is on me. Next is the concentration risk. This is the risk of having losses when money is concentrated only in one type of investment, like solely invested in stocks, and stocks are highly subjected to market volatility. Whereas when I diversify my investment, the risk will be spread over and it will be mitigated to prevent greater loss in the future. Next is the company risk. This risk is also known as corporate risk, which is probably the most prevalent threat that investors face when buying individual stocks. Like if I own shares in a company that does not generate enough income or profits, I will lose my money and I cannot get it back since it was invested in stocks, and in the first place, I already knew that this kind of event is possible to happen, but I take the risk. So, poor operational performance can reduce a company's market value, and in the most extreme situations, a company can collapse completely, leading to a total loss of my invested capital. So, for the bond portfolio, the associated risk is the inflation risk. This is the risk of losing purchasing power because the value of the investment is not keeping up with the inflation. Inflation risk is especially relevant if you own debt such as cash or bonds. Credit risk. This is the risk that a government agency or company that issued the bond will possibly face financial difficulty and will not be able to pay me the amount of interest or repay the principal by the right on time on its maturity date. Next is the market risk or the interest rate risk. It's a risk that an investment will lose value as a result of economic development or other events affecting the market as a whole. This risk is for debt securities such as bonds. This is the possibility of losing money if interest rates change. For example, when interest rates go up, the market value of bonds goes down. So lastly, the reinvestment risk. It's a risk of suffering loss due to investment of capital or income at lower interest rates. For example, suppose I bought a bond with a 5% payment. If interest rates fall and I need to reinvest 4% of the regular interest payments given to me, then I am experiencing the risk of reinvesting. The risk of reinvestment also rises when a bond expires and less than 5% of the principal needs to be reinvested. If I plan to spend the regular interest and principal on time, then I may not have to face the risk of investment. So that's the performance test. Risk, investment risk. So the next one that I'm going to flash is the preference task tree, which is the asset allocation. So here for the equity investment, I invest Banco de Oro cash for 25%. For Jollibee Food Corp, stocks is 15%. LPLDT cash 10%. For the Bank of the Philippine Islands is cash 25%. For Ayala Land, stocks is 25%. So for the debt investment, for Sun Life Prosperity GS Fund, the asset allocation are the government bonds with 70%, money market with 20%, cash 10%. For Suldebo Bond Fund, the asset allocations are corporate bonds, government securities, and cash. Corporate bonds is 10%, government securities is 75%, cash is 15%. For Phil Equity Peso Band, 25% for the cash, 5% for corporate bonds, 20% for government securities. And for Sun Life of Canada Prosperity Bond Fund, government bonds with 52%, corporate bonds with 25%, cash with 23%. And lastly, for the Atram Corporate Bond Fund, corporate bonds is 55%, government securities is 30%, and for cash 15%. So here is our explanation. I write it here, so I'm just going to flash it here. So that's it. That's my preference task 3, asset allocation. Thank you for listening. Bye-bye. Keep safe. God bless. Merry Christmas. And Happy New Year.